All right, today we're doing something a little different. We're not just looking at a stock, we're actually going to tear apart a professional's entire playbook. Think of this as a masterclass, using JPMorgan as our case study. Let's get into it.
So, what's the first thing a pro looks at? The upside. And in this case, we're talking about a potential 29% gain. That's a number that definitely gets your attention, right? But, and this is a big but, it's only half the story.
And here's the other half, the side that really matters to a professional, the risk. We're looking at a maximum loss strictly capped at 6.9%. This isn't some guess, it's a hard line in the sand. You see, knowing exactly what you stand to lose before you even think about placing a trade, well, that's the foundation of professional trading, period.
Okay, so how are we going to break this all down? Simple. We'll start with the bottom line, the core idea. Then we'll get into the disciplined entry strategy. After that, the non-negotiable risk rules, how to take profit systematically, and finally, how you can actually take this framework and make it work for you.
All right, first up, the professional's bottom line. Look, every single move a pro makes starts right here, with a clear, quantifiable reason for being in the trade. No fuzzy logic, no, I have a good feeling about this. You have to know exactly why you're putting your capital on the line.
So here it is, laid out plain and simple. On one side, you've got the opportunity, a potential 13 to 29% gain over the next year, year and a half. On the other side, the risk is strictly defined, a maximum loss of 6.9%. You see that? That imbalance, that asymmetry, where the potential reward is so much bigger than the defined risk, that's what makes this an attractive trade.
Okay, so you've got your thesis. Now, how do you actually get into the trade? This is where amateurs and pros really differ. Professionals almost never just jump in with their full position all at once. Instead, they build a position strategically. It's all about removing emotion and getting a better average price.
So this playbook uses a three-zone approach. It's pretty smart. Step 1 is the aggressive move. You put about half of your planned capital to work right away. Then, step 2, the standard entry. You wait for a small pullback, maybe 1 or 2%, and you add another 35%. And finally, the patient part. You keep that last 15% in reserve, waiting for a bigger dip of 3 to 5%. See how that works? You're layering in, trying to build a really solid average cost for your position.
All right, so we're in the position. Now we come to what is, without a doubt, the single most important part of this entire playbook: protecting your money. And let me be clear, what we're about to cover, these aren't suggestions. They are ironclad, absolutely non-negotiable rules.
Automatic exit. No exceptions. No averaging down. Just listen to those words. It doesn't say, think about getting out. It says automatic, exit. No wiggle room, no second guessing. And this is huge. Absolutely no averaging down when a trade goes against you. When the plan says it's time to go, you go. That's what discipline looks like.
So let's look at the actual mechanics of the exit plan. The main one is the hard stop at $295. If the price hits that level, that's it. The thesis is broken and you get out of everything. That's what locks in that max loss of 6.9%. But there are also other layers, like a trend stop. If the trend starts to break down, you might sell half your position and just reassess. Every level has a specific price trigger and a specific action you have to take. It's all planned out in advance.
Okay, so we've covered getting in and we've covered getting out if things go wrong. Now for the fun part, how to take your profits. A pro doesn't just hope to sell at the very top. That's a fool's game. Instead, they have a system for locking in gains as the trade works. It's called pyramiding out. And here's what that looks like in practice. As soon as the stock hits that first target, let's say $340, boom, you sell 30%. Why? Because it takes risk off the table, it locks in a gain, and frankly, it makes it so much easier psychologically to hold the rest of the position. Then you just follow the plan, selling off more pieces as you hit each new target all the way up to that final bull case. You're systematically cashing in your winnings.
So that's the playbook. But, a plan is useless if you can't adapt it to your own situation. So now we're going to talk about how to take this professional framework and actually make it fit your personal style and your risk tolerance. First off, where do these price targets even come from? They're not just numbers pulled out of thin air. They're actually based on different valuation scenarios. You look at different possibilities for earnings growth and what the market might be willing to pay for those earnings, the PE multiple. And that gives you a range of targets, from a base case to a really optimistic one. It gives the whole plan a solid foundation.
Okay, so let's say you're a more conservative investor.
How do you use this? Well, first, you'd probably use a much smaller position size, say 2% of your portfolio. You might even decide to skip that first aggressive entry and just wait for a better price. And when it comes to taking profits, you'd probably sell half your position at that very first target, just to lock it in and de-risk. But, and this is key, that hard stop at $295, that's still non-negotiable.
Now, for a moderate growth investor, you're pretty much following the playbook as it was designed. You'd use a balanced allocation, maybe 3.5%. You'd scale in using those first two entry zones, and you'd follow that four-step profit-taking plan to the letter. And for risk, you'd be using both the hard stop and that secondary trend stop for a bit more of a nuanced approach.
And what if you're a more aggressive investor? Well, you might decide to allocate a larger chunk of your portfolio, say 4 or 5%, and you'd absolutely use all three entry zones to build your full position. When it comes to selling, you might follow the plan but decide to hold that last little piece for a potential home run. But, and I can't stress this enough, with a larger position size, that hard stop at $295 becomes even more critical. It is your absolute safety net.
So there it is, the complete professional's playbook. Methodical, disciplined, everything is planned out. And really, it all boils down to one simple question for you to think about. Does your current investment process have this level of discipline for getting in, for managing risk, and for getting out? And if the answer is no, what's one thing from this playbook you could start using today to change that?